What's up you guys, Tommy Shaw here, and on today's channel the big question is, why does the Fed manipulate interest rates? Okay, it might be obvious for some, but maybe for some it's not really obvious, and I wanted to explain in normal conditions and with the Fed how the environment would react. Okay, so first of all, in normal conditions, when we go into a recession, we can expect the GDP to drop. We can expect that income for some businesses to drop. And what happens is that if the majority of the businesses, the debt to income percentage of debt to income increases, we can convert that into risk. Okay? So what impact will that have on the WACC, the weighted average cost of capital? And to look at the WACC, we need to understand that there's investors and there's debtors. So investors are looking to get return on their capital, while debtors are looking to get interest or coupons on their obligations. Okay? So in normal conditions, what would happen is that the market would perceive more risk. So investors and debtors would ask more returns. So you're already having a contraction. This would contract even more the value of, or it would worsen the conditions of these businesses. So if we look at it, when the WACC increases, the value that you can get out of a business decreases. Okay? So with the Fed, when the Fed comes around, they look at this and they say, we can't let this happen. So what do? They buy treasuries, they buy the yield curve, the obligations from the government, and they buy the whole yield curve, or they buy upfront to try. Well, what they do essentially do is that they reduce the overnight lending to the lowest as possible, because if you can borrow at 0% interest or real value, real interest cost, what's going to happen is that it's going to reduce the weighted cost of capital, because people are going to borrow more and go to seek for capital. They're going to look for less capital and more debt, which will create a bubble, but it's going to fix the problem short term, because it's going to either increase the value of those assets or maybe stabilize it a little bit. So that's why the market needs the Fed to artificially correct. But at the same time, if the Fed wasn't there, this business would go out of business and a new one would take its place. A more profitable one, a better one would take its place, and the market could correct and be more stable and protect itself. On the other hand, we're just pushing the problem further. It doesn't mean that this business will be able to innovate, change its style of investing. So what we're essentially doing, we're just pushing risk further down the road. Okay? So if you like this kind of information, short video, making it easy. I always get comments down below that I'm always straight to the point. That's my personality. I'm always straight to the point. I don't like to talk. I like to take action, and I like to get results. Okay? So here you go in this short video. If you like this kind of information, like, subscribe, and I'll be seeing you on the next video. Thank you.